one of the world's most active early-stage venture capital firm, managing over 500 million in assets.
Really, FJ Labs started off as a family office of two tech entrepreneurs.
200 inbound opportunities every week. You invested in over 1,000 companies. It's really a huge number.
I had always loved technology growing up. I always was an early adopter of gizmos and gadgets. But at the time, in the early 2000s, there really was no tech and venture scene in New York. They needed someone who could help institutionalize and scale a venture fund. They would teach me investing. I would teach them fundraising. That was early 2017, and it's been an amazing journey ever since. Our process is 2 phone calls. We do 2 45-minute phone calls. So for a ticket of, on average, $300K, that's pretty good dollars per minute. Once you get on that venture treadmill, that like hamster wheel, it's very hard to get off. So just buyer beware and consider not creating such a binary outcome with your company.
Good morning, good afternoon, good evening, dear friends. This is a podcast, Ventures from the Valley, which is brought to you by Viktor Adlovsky and R136 Ventures. We have an exciting guest today. Jeff Weinstein is a partner at FJ Labs, where he co-heads the investment team at one of the world's most active early-stage venture capital firm, managing over 500 million in assets and thousands, I believe, of startups. FJ Labs is a venture fund founded by Fabrice Grinda and Jose Marin, headquartered in New York City. Welcome, Jeff.
Thank you for having me. Nice to see you.
Thank you. So let's start with your journey. So you started at FJ Labs in 2017. You were promoted to a partner, which I know is very difficult. And it's like a huge reward to become a partner in 2021. So it's like in less than 5 years. So that's an amazing upgrade. And you had a vast experience in hedge funds before. We will definitely speak about that, but give like a little bit of your story in your colors, in your flavor.
Sure. It's interesting. Growing up in New York, there wasn't really much of a tech industry when I was growing up. It was very much a finance town. And in fact, my dad actually worked in finance. So when I was in university, I didn't really know what I wanted to do. I had always loved technology growing up. I had attended computer camp. I took some computer science classes in high school, and I always was an early adopter of gizmos and gadgets. And so I loved technology. But at the time, in the early 2000s, there really was no tech and venture scene in New York. So I did the thing that was normal for New Yorkers to do after graduation, is I went to go work in finance. And so I worked at a small fund of hedge funds in New York called Dunbar Capital. And I was there for a couple of years, and I'm very grateful for that time because it was a taste of asset management, and it taught me a lot about alternatives. And then from there, I ended up getting a job at a small venture firm in New York called Lux Capital. And so at the time, I was doing LP fundraising for Dunbar, helping them manage investor relations. And Lux was looking for somebody to help them scale up the LP side of their firm. And that was fantastic because at the time, no one had really heard of Lux. It's a bigger name now. I think they managed north of 6 billion AUM. But at the time, they had just raised their second institutional fund. So their AUM was about 350 million. And the New York tech scene was growing, and Lux was starting to build its brand. And I was there for 4 years, and I learned so much. And I'm still very close to the Lux guys. I'm extremely grateful for my time there. And that was my first taste of venture. And that's when I knew I loved being at the intersection of technology and finance. And so I was at Lux for 4 years. And I actually thought I was going to go to business school because I was doing fundraising, but I had always loved investing. I would invest my PA. And the truth is that Lux is such an elite specialized firm that most of the investors there have a terminal degree in the hard sciences. Lux is all about deep tech and frontier tech. And that wasn't my background. I was a PPE major in undergrad, politics, philosophy, and economics. And I've always been a bit of an investing nerd and a markets nerd, but I didn't have that hard science pedigree. And so I was going to go to business school, and I actually just got very, very lucky in that I was catching up with an old friend of mine who I met at an undergraduate business conference. There was this conference called Business Today that Princeton put on. I went to Penn, but Princeton hosted it. A friend of mine at Princeton invited me and said, hey, you should come. It's a nice weekend in New York, really interesting people. And I met this guy there. We stayed in touch. And 10 years later, I saw he was in venture. I said, I'm in venture, you're in venture. Let's grab coffee. And he told me he was actually at this firm, FJ Labs, and he was starting a new company and he was looking to basically hire his replacement. And they had just raised their first outside capital from LPs. It was originally a family office, and I can talk about that. And then they needed someone who could help institutionalize and scale a venture fund. And it was really a perfect fit. They would teach me investing. I would teach them fundraising. And that was early 2017, and it's been an amazing journey ever since.
That's an exciting path, really. So actually, I just heard I just listened for last podcast with Mark Andreessen, where I think he told kind of an unconventional thing about venture, that when best students, best graduates go work for technology companies, that's the time when it's a hype and you should stop investing. While when they go and work for Wall Street and investment firms, this is the time when you should invest, because venture is cooling down, and that's a good time to entry. Do you agree with the statement?
Yeah, I love that concept that MBAs are the great contra indicator, that wherever they're flocking to is at its peak and you should look elsewhere. I don't actually know. I will say that I think venture is no longer popular for new graduates. Frankly, in the venture job market is in a deep recession right now. I mean, most new firms are not only not hiring, but they're actually firing. And I think that's just a downstream of the fundraising environment, which outside of some of the top brand name firms like Andreessen Horowitz, it's actually a very bad fundraising environment. So I'm not actually sure. For a while, it was search funds. I don't know if you've heard, the concept of entrepreneurship through acquisition, search funds. That was all the rage in MBA land. But I'm not actually sure what's going on. I should look into that. I don't think it's venture nowadays, actually.
Well, yeah, I do agree with you that it was a venture for at least fundraising. So maybe we can a little bit touch on this fundraising role you played. And are you still in charge of fundraising for FJ Labs?
It's a team effort, but I do lead a lot of the fundraising initiatives. Okay. So we have a head of IR who I work with, and we tag team a lot of the fundraising, and our co-founder Jose does a lot of the fundraising as well.
So you are a relatively large fund, but yet it's sub $1 billion, right? And from what I see going fundraising, so we are almost the same size as R136. When we go fundraise, we really see that top 20 firms are eating it all. So they have become kind of giant, and there is a clear separation between top 20 who are billions of dollars, and they keep fundraising, right? I mean, there is no real concern or anything wrong with that. But they're taking the entire stake, right? Yes. So what would be the strategy for a small firm to fundraise, and how would you differentiate yourself across the industry?
It's a real problem because you're seeing a couple of phenomena happen at the same time. So first of all, funds are getting bigger than ever before. $1 billion fund used to be big. Now you're seeing $5 billion, sometimes $10 billion funds. I mean, you're seeing $1 billion SPVs. You're seeing $10 billion SPVs in just single names. The capital needs of some of these AI companies are so unbelievably large that you're all the field of play has been completely warped. And what's interesting is that these funds are not even funds anymore. They're really asset management platforms. They're almost like the West Coast version of a Carlyle or a KKR. And in fact, many of these look like they're going to go that route. They're adding family office arms. They're adding lending arms. They're adding hedge funds. And I think some of them are going to IPO. I wouldn't be surprised if some of these actually IPO and become public asset managers. So if that's the case, their North Star is not financial returns. Their North Star is AUM, which is fine. I mean, look, I think some of these people are amazing. They're heroes of mine in many ways. Like Mark Andreessen is an absolute legend. That said, leave some for the rest of us, right? And so you're seeing this bifurcation where you have sharks and minnows, and you have these mega funds, which, by the way, are also the ones with the multi-decade long track record and the relationships with all of the big LPs and pension funds and sovereign wealth funds. And so they're taking an unprecedented share of the pie. And then you're seeing a bunch of LPs gravitate, I think rightfully so, towards emerging managers. So you're seeing some very hot managers that are sub 100 and sub 200 million it's kind of an open secret that emerging managers often perform very well because they're smaller, they're hungrier, they're leaner, and they're not getting fat on management fees. And so LPs, you've got this kind of missing middle where if you're a fund between 100 million and $1 billion, it's actually a really, really tough time to fundraise, particularly if you don't have a long enough track record. And with venture, things take so long, and actually they're taking longer than ever before. Our fund one was 2016. So we're at about 95% distributed for that, which is solid. But
that's very solid.
What that means is that only now are you returning that capital. So that means that if an LP wants to basically recycle the proceeds of exits into the manager, you're talking like a 12-year, 14-year loop or like a cycle. Yep. And so even, we've been around for 9 years as an institutional fund. Fabrice and Jose have been angel investing for about 25. But the ones who have gathered all the assets are usually the 20-year-old plus firms. And so what I've heard is that I think they say around year 14 is when it starts getting easier. And so I think, hopefully for us, maybe in 3-4 years, it'll be a bit easier. But that's an awfully long time to have to persevere and build through a firm. And often they say that when you're raising fund one, you can raise off of story, or you raise this proof of concept. And then fund two, you can kind of build on that story a little bit and say, hey, we did what we said we would do, and we're going to do that again. But by the time you get to fund three, fund four, if you don't have some early DPI, it's really hard to raise right now.
Absolutely. I totally agree. Yeah, and I think that DPI is a key word and the key thing indeed for like many funds nowadays. So let's go to your strategy, and it's an early stage fund, but it's somewhat like very unique in a way because you are looking at around 200 inbound opportunities every week. And you invested in over 1,000 companies so far. So it's really a huge number. So maybe you can give a little bit of insights of how you manage this all. So what does your calendar look like? How much time do you allocate towards spending time with hundreds and hundreds of companies versus looking into new companies, and how you do it all? I mean, how big is the team, and what's the secret behind it? How do you find a signal from the noise?
Yeah, our model is very unique. I think it's helpful to explain why we do what we do and the history. So really, FJ Labs started off as a family office of two tech entrepreneurs, Fabrice Grinda and Jose Marin. They've been building tech startups since the late 90s, the Web 1.0 era. And so Fabrice, he's originally French. He was educated in the US at Princeton. He had a brief stint at McKinsey, but then his first startup that he built was an online auction site for LATAM. A lot of the Web 1.0 era, you had this, and by the way, you see this now as well for what it's worth. And I actually still like this model, but you have this concept of X for Y, finding a proven business model and transposing it to another vertical or another geography. And so Fabrice's first business, if you really distilled what it was eBay for France. And actually, Jose built a business which was eBay for Latin America, online auction site like eBay. And that's how they actually met each other. Jose and his team at Deramati.com in Latin America, they licensed Fabrice's software and his server stack at Auckland. And so that was the beginning of a long and fruitful business relationship where they started to make some money from the exits of their startups and reinvested it into the ecosystem. And by nature of being relatively well-known consumer founders, they started to get a lot of deal flow, and founders wanted to learn from them and work with them. And they still had day jobs as founders, so they had to come up with basically a systematized way of evaluating startups. And so that was really the genesis of FJ Labs, is that developing this muscle of angel investing, not leading, not taking board seats, co-investing alongside blue chip VCs with whom we've known for decades, and being relatively hands-off, light touch, and writing smaller tickets, which started off as 25 or 50K tickets, has now scaled to 250 to 500K tickets, but the principle remains the same. We love marketplaces. We love network effects businesses. Network effects lead to very large winner takes all or winner takes most outcomes. And you can foster network effects everywhere in the world. And in fact, in an era where AI is transforming things so dramatically, and we can talk more about this later, but we think that network effects are a great source of defensibility and actually matter more than ever before. So fast forward to 2015, 2016, when I started to meet the FJ team, they had been angel investing at scale for about a decade and had built their own personal angel portfolio of about 150 startups. And in came a very large Norwegian corporate called Telenor. Telenor is a state telco, basically half private, half owned by the government of Norway. And they had entered into a JV with a very large media company called Schibsted. Schibsted owned online classified sites all around the world, and actually were Fabrice's biggest opponent. Let me fast forward for a second. So Fabrice builds Auckland. He sells that for equity at the peak of the dot-com bubble. So it doesn't actually, the stock goes down like 99%. He sells it to a business called QXL Ricardo, which is still publicly traded, actually, a Swiss company. And then he parlays some of his proceeds from that into a company called Zingy, which is a mobile phone ringtone marketplace, like basically a place to buy cell phone ringtones.
Yeah, I remember the company, yeah.
Oh, yeah, okay. So he grew it from 0 to 200 million of sales in 4 years. He ended up selling that one for cash to a Japanese conglomerate called Forside. And that's when he could really start to angel invest at scale. And so last but not least, he built a business called OLX, which is one of the world's largest online classifieds conglomerates.
Yep.
Stands for online exchange.
I know them well as well, yeah.
So
yeah, it's an amazing company.
He raised from Jeremy Levine at Bessemer. He raised from Founders Fund, General Catalyst, DN Capital, and others. And by the way,
Naspers, I think, is a big investor there.
So he sold it to Naspers. He sold it in 2010 over a series of transactions and stayed on as CEO till 2013. And so all the while building network and relationships and brand and reputation, all which contributes to that deal flow engine that we benefit from today and we continue to foster. And so what that led to is this interesting place in the market where you start to see the emergence of super angels, where you used to have small business angels, but you start to develop people who will not just do a couple of investments in friends and family, but actually build a reputation and start to do tens of investments. And in the case of Fabrice and Jose, hundreds of investments. And one thing leads to another. And we end up raising outside capital in a first fund, 2016 fund with a single LP. And I join and we start to build an investment team. And you fast forward to today, we have a 20-person team, 10-person investment team. We just finished investing our $290 million Fund 3. And we've really built this incredibly powerful flywheel where we basically ingest all of these deals from all around the world. We selectively outbound ones that interest us, and we end up investing in north of 100 startups per year globally, with a focus on early stage, with a focus on marketplaces and network effects.
How early it is? Is it like pre-revenue, pre-product, pre-product market fit? What is it? I mean, how early it can go?
We can go extremely early, but we prefer not to. This is another unique thing about our model. When most people hear the phrase angel investing, they associate it with pre-everything. Friends, family, and fools.
That's what angel stands for, yeah.
Yeah, that's not how I use it. But the way I use angel is I mean it as a quick deciding, passive co-investor writing a small ticket. And I mean, now we have a fund, but with Fabrice and Jose being kind of the prototypical angel investors. But because of the aforementioned dynamics of network effects leading to winner takes all or winner takes most outcomes, you don't want to pick the wrong horse. There are not many winners in each category. And so
there are more and more startups, right? With this AI, we'll come back to AI and how like this landscape is changing. But I think that if there were only hundreds of companies tackling a problem, whatever the problem is, like 3-5 years ago, that matures into like thousands or maybe dozens of thousands of startups nowadays. So it's really hard to choose, right? Because they are all in a kind of an early stage in doing almost the same thing, especially with all these LLMs. They're just building on top of LLMs. So you never know who will win. And that's like an interesting insight. Maybe you can share. But
yeah, absolutely. And I can talk about how we see that world. But given we focus on marketplaces and network effects businesses, we benefit a lot from early evidence of product market fit. We're not taking tech risk here. It's all about execution risk. And so we're not betting on a highly scientific team that's looking to innovate using some new patented technology. It's no.
So all this LLM stuff, like foundational models, isn't something what you would kind of doing, right? I mean, because it's a deep tech in a way, right?
Yes.
No hardware, for example, even if it is a consumer hardware.
Now, I will say, there are exceptions, and I can talk about Figure AI, which is this crazy humanoid robot company we ended up in because we had backed the founder before. But typically,
certainly not a consumer-facing app or whatever. Maybe a marketplace at some point, but nobody knows.
It's really not a marketplace, but that's okay. The founder previously built a marketplace, and so we really have a strong preference for execution risk over tech risk. And so I would rather wait a little bit to see how the founder has been operating and to see early evidence of product market fit. And so my favorite place to invest is really late seed to Series B, not pre-seed. We will on occasion do pre-seed. We typically call that a flyer or a founder bet, but the bar is very, very high. And so more than ever, by the way, in an era when you can vibe code your way to an MVP and you can do more with less, we expect to see more traction than we used to. Because you don't, when Fabrice was building his first company, you needed millions of dollars just for servers. Nowadays, it's never been cheaper and easier to build a product.
Indeed.
And so
you can do it like in days. And by the way, you do not need to have any knowledge of tech, right? You may even have no knowledge of like coding, right? I mean, it could all be done like with all these tools, like with like almost no code, low code mode, right? Yeah,
absolutely. And so that means two things. One, I expect to see at least an MVP when I'm looking at startups nowadays. Sometimes people will pitch us and they'll say, we need to raise $5 million to go build a product. 9 times out of 10, 99 times out of 100, I say, no, just like go vibe code something, show me what you have in mind. Obviously, that doesn't mean it's going to be production ready, but show me you have agency. Capital is not the limiting factor nowadays. It's agency. Like, I love that quote. You can just do things. It's true. You can just go do things. It's never been more democratic in the way you can build a company and build a business. And so we expect to see more at the early stage. And then because as a result, it's never been easier to go build competition and there's never been more competition. I want to wait and see who the breakouts are because I don't want to bet on Lyft when there's Uber. And so I would really like to see, okay, even if it's not proven, I'd like to see the momentum and see, okay, wow, they're growing really fast. Wow, they're super metrics oriented. Wow, they're out competing their peers. I do care about competitive landscape when I'm investing, particularly when there are low barriers to entry, which, by the way, I'm starting to care more and more about barriers to entry, just because in a world where the barriers are coming down due to all of these coding tools and the prevalence of AI, how do you think about investing? It's like you said, it used to be the case there was only Uber or Lyft, but now there could be hundreds or thousands of competitors. And so I think a lot about defensibility nowadays, more than I used to when I was starting my career.
Let's go a little bit deeper in this particular area. So you mentioned this angel type of investing, although it's not like angel, like not friends and family and pools, but like very smart way of investing, and definitely not friends and family. Yet you have to really be fast and very efficient in making decisions. You could not make tons of due diligence, right? So can you just name a few key differentiators for companies? Whom would you select? I know that there is like an industry and a potential of the market. That's right. But what are you expecting from founders? And I'm sure you're not looking into data rooms, right? I mean, it should like be a presentation and the founder.
We are actually.
Oh, you are. Because I mean, it should take like for you like a very high spin, right? To make so many to review so many opportunities, and probably how much time on average you spend on your investment case. So making a decision, go or not go.
People derisively call our model spray and pray, but then I've had some people join our investment committee meetings, and they're always shocked and pleasantly surprised by how rigorous we are in the evaluation. And I think the way you can kind of meld those two conflicting views is you think about the Pareto principle, the concept that 20% drives 80% of the value. And you see this power law and this distribute all around the world. And you see that in venture. And so what we see is basically, if you really get to the crux of the matter, that's all you really need to know about a business. And so think about, here's how we short circuit the investment process. Okay. We don't set the deal terms ourselves. We don't lead and we don't take board seats. So now you've cut out the entire term sheet negotiation process. You've cut out all of that time being on boards. I've been on some boards. I really don't want to do that. It has to be a super unusual exception. Like we think that, with all due respect to our friends who lead deals and take board seats, they're doing God's work, and we are happy for them to do it for us. And so the way we short circuit so much of the work is by co-investing alongside blue chip VCs with whom we have multi-decade long relationships. So when Jeremy Levine at Bessemer is leading a Series A in a marketplace, and he leads a $10 million round with a $7 million ticket, he's more often than not happy to cut us in for $500K alongside him, because he knows, having been on the board of OLX, and he knows Fabrice's skill as an operator, and he knows the FJ Labs expertise and reputation, we're the type of syndicate partner that he wants for marketplaces. And so Bessemer sends us a deal and they say, hey, we're leading this marketplace. Like I said, $10 million Series A, we're writing 7. So then we immediately take a quick call. In the case of, now we will treat, if a Jeremy sends us a deal, it goes straight to a senior partner.
Right.
Typically a cold inbound deal, we have one of our 4 junior team members take a screening call. So I'll give you that example. Let's say we get a cold inbound. One thing that's unusual about FJ, by the way, all of the cold inbound deals that we get, we review. A lot of VCs only take warm intros from vetted partners, which I totally understand. But we've had some diamonds in the rough where we've
So an advice to those who listen to us, who consider fundraising, just go and send an email to FJ Labs, to Jeff.
No, that's not.
And most probably you will be reviewed, not will be like put into.
You will be reviewed, but warm intros are better for sure. Like my advice actually is, if you're trying to pitch FJ Labs, find a warm intro with someone in your network who can serve as social proof.
So warm intros are still good. Yeah, good to hear.
But as I was just saying, the cold inbounds are treated differently than the warm inbounds. We review the cold inbounds. It doesn't just go straight to spam, but they are reviewed in a different and a lower bucket. Because going back to the agency concept, it's not that hard if you're a high agency person to work the network and work the angles to get a warm intro. And that's the typical VC mindset, which is true. And I agree with that. But I'm just telling you, we do still use some of our junior resources to review the cold inbound.
May I ask you a provocative question on that? Sorry, jumping on that. It's important. Have you missed anything big while passing on pure inbound opportunities? Have you seen anything what you like reviewed in a light way, which you really like missed, like a big thing, something, was it like something in your memory? And do you analyze this stuff, like what you haven't invested in? How does it
Retail
go? Like
portfolio,
this
yes. Yeah.
shadow portfolio, whatever.
Yeah. Or anti-portfolio, if you call it.
Mm-hmm.
Yeah, I mean, absolutely. If you're not having a good anti-portfolio, you're
Mm-hmm.
not a good investor. And that's why I like that Bessemer, for example, they published their famous anti-portfolio. I have some painful ones, absolutely. I mean, the worst miss, it's funny, it's not actually even a deal, it's a fund. We were investors in Multicoin's hedge fund, and
Yeah.
Multicoin is one of the most successful crypto funds ever. And the hedge fund did very well for us, but they sent an email out for their first venture fund. And I think I was on paternity leave. And so we didn't end up investing.
Mm-hmm.
And that's one of the best performing venture funds of all time. They did the Series A of Solana. And so that one to this day is extremely painful. But don't cry for us. We did the hedge fund, But there are others. I mean, we passed on. I remember passing on OpenSea when they were in Y Combinator because we thought that digital collectibles, how big could that be? And so now the funny thing is that OpenSea they went all the way up to the 12 billion and they went down. But we sell secondary, so that would have been a chance for us to exit, like at least partially, for sure.
True.
But yeah, I mean, many examples. Just today, Polymarket announced their raise of $2 billion at a $9 billion post led by ICE, I guess the New York Stock Exchange, the very large stock exchange company. And I begged to get in before, like early on, because I was a user of Polymarket, and so I don't remember what year it was, maybe 22 or 23, when it was starting to build up to the election. I got an intro to Shane, and we were like begging him, listen, this is right up our alley. It's a marketplace. Like, please let us in. And we couldn't get in. And now look at it. So, but yeah, I mean, every VC worth his or her salt should have
absolutely
dozens of stories like this. Yeah. If you don't, you're not fishing in the right pond.
That's true. Yeah. So, sorry, I interrupted you. So we were speaking about this like Angel's mode, but still like going very deep. So warm interest somewhat is important. So still, like, what are the qualities of founders are looking like for? I mean,
right.
what would make it? I know that you could not open all secrets, but at least
open some. We will actually, because we think that for us, by nature of being kind of the friendly, collaborative co-investor, we are able to share more than others are. There is no secret sauce. Actually, quick aside, one of my favorite books for business and for business strategy, it's a book called 7 Powers by Hamilton Helmer. And it talks about the various sources of, call it, persistent differential return. And we use this to think about startups that we're investing in. Like, what is your defense? What is your defensibility? What is your edge? And one of the 7 powers is, of course, network effects, network economies. That's our favorite. It's not the only one, but it's very common in startups to see people try to build network effects. Anyway, I think a lot about FJ Labs and what are our persistent sources of differential edge or return. And so you have brand power. We've built a brand. By being on this podcast, I'm helping to build the FJ Labs brand. And then we have network effects ourselves, where the more deals we do, the more surface area we have, the more founders that send us deals, the bigger our founder network grows, the more deal flow we get. The more deal flow we get, the better we get at pattern recognition and pattern matching. So anyway, I'm very open about the way we invest. And so transitioning to your question, the way our process typically works is as follows. We get an inbound deck. Depending on who it came from and how, we triage it and we send it to a different team member. If it's a cold inbound, it goes to one of the junior team members. If it's Jeremy Levine or like a prominent VC who we know and we trust, it goes to a partner. At that point, we think about the following heuristics. You mentioned market size. We want this to be $1 billion plus market. Now, a lot of VCs will pass due to market size, but we've seen enough times that startups can conquer a small market and then expand across different categories and geographies. So we really use market size instead as a way of understanding the thoughtfulness of the founder. In other words, like, does the founder, even if you're starting in a small market, do you at least have aims to expand to another market or geography? And if so, what are your aims? So to give you an example of a market that sounds tiny that we recently invested in, we invested in a business called Palm Street. Palm Street is a live shopping app for plants. So they started off with selling, it was basically stores selling live plants on video, okay? Sounds tiny, right? Well, first of all, it's bigger than you would expect. But of course, there's category expansion. So now they're selling like gemstones and lizards. And they're basically becoming like Whatnot, what they do with trading cards. It's like Whatnot for the female demographic. And so if some VCs might say, oh, plants. I mean, I'm not investing in a plant store. Yeah, but you have to think more about like the natural category expansion, and better to dominate your category and then expand than to just try starting in the world's largest category. So that's how we think about market size. In terms of founder archetype that we think about, we care a lot about two things. We want to see good storytellers because storytelling reduces your slope of fundraising, of recruiting, of business development, winning deals. And it just makes everything easier. And so we'd like to see good storytellers, and or we'd like to see highly numerate, execution-oriented founders. So previous history of excellence, whether it's operating excellence, academic excellence. We're more willing than other VCs to back first-time founders because of the type of deals that we're investing in, which are often these marketplaces that are really execution-oriented. We actually like MBAs. That's something that most VCs strongly disagree with. But we've done great investing in MBAs because MBAs are often very strong in terms of execution, operations. So we have no problem investing with MBAs. But that, I think, is specific to the type of business we're doing. You don't necessarily want to back...
Are investing in droppers, like drop-offs from universities, colleges?
Oh, dropouts.
Yeah, dropouts.
Yeah,
Sorry,
we would. We have. I mean, I wouldn't say we look specifically for dropouts.
What's your youngest founder?
Oh, that's a good one. I think the youngest one I can think of is 19. I would not say we're looking for young founders. I think we are open to young founders. But, there are some other funds that have this thesis of like, we only back dropouts or we back super young founders. I'm honestly open-minded. I'm happy to do older founders. I'm happy to do first-time founders. I'm happy to do second-time founders. I just want to see good founder market fit. Like, why are you building what you're building? What's your connection to this market? Is there one? What's your right to win? What is your academic or operational pedigree? Have you demonstrated excellence in the past? And so if you think about Fabrice and Jose, I mean, Fabrice he didn't do MBA, but he was at McKinsey, which is kind of like a paid MBA. And then Jose was actually at Stanford GSB. And so we like MBAs. I mean, frankly, a lot of people like hate MBAs. I'd say not only do we not hate them, we actually like them for the type of businesses that we invest in.
Do you necessarily speak with founders, or you may rely on some, like, say you said Bessemer will go straight to your like top level? Is it like must have that you meet founder, or
no? We absolutely, and
so if founder says just I don't have like much time for your 25, 50, whatever 100 grand ticket in my 5 million round, would you invest still? Like if you think that the founder is right, you want.
Our process is 2 phone calls. We do 2 45-minute phone calls. So for a ticket of, on average, $300K, that's pretty good dollars per minute,
Indeed.
So even like, we are cognizant that we have less leverage in $1 billion round than in $1 million round. And there are extremely rare exceptions where we don't talk to the founder, where we feel like we have enough knowledge about the company. That's usually at the late stage. And one other thing we can talk about is that we're not only early stage. We're mainly early stage, but we have done very successfully some late stage deals. And so We came into Anduril at 8 billion, for example. I did not talk to Palmer Luckey. I did not ask him dumb questions for, we did $1.5 million in that Anduril round. We will go a little bit bigger at late stage, by the way. We'll do like 1-2 million, something like that. And then we invested in Farfetch at $1 billion. That ended up being quite profitable for us. We came in late in Uber and Alibaba. So in those rare occasions, yes, we do not talk to the founder, but that is very, very rare. And our bread and butter is, call it late seed to Series B. And so Bessemer sends us a deal, or say General Catalyst sends us a deal. We take a first call with the founder. That's typically one of the junior team members. And we have a template that we use. It's not quite a checklist, but it's a standard debrief template where we basically talk about like what's the business, what's the business model, what are the early metrics, what's the founder background, what's the founder pedigree, what are the round dynamics. We care a lot about round dynamics, and I think VCs should care about this more actually. How much are they raising? At what price? What's the syndicate? Most importantly, how far does this round take you? How much are you burning? How much cash do you have? Do you have any debt? And where do you think this round takes you in terms of runway, in terms of traction, and then what? At how much is the business worth at that point, and then how much are they raising at that point? And so then they send out that debrief. Then we present to IC. We have a debate at that IC, and our options are pass. We don't like it. We don't like the market. We don't like the founder. Pass.
Most of them, I believe, are what you pass upon, right? And then probably like a percentage which you accept is like fairly small.
The funnel is like this. We get about 150 plus inbound deals per week. Out of those, about 30 to 40 graduate to a first call. Out of those, usually 10 to 12 make it to investment committee. At that point, we can pass. Usually, if you make it to investment committee, it's interesting enough to discuss. So then you usually pass and reconnect, which is we like it, but we don't like it right now. We don't like the valuation. We don't like the round terms. We don't like, we think they're going to have to raise again in a year.
So you like a company, but we do not like the moment at which companies invest, whatever reason.
And what we do is we set a reminder in our CRM and we check back with them in advance of their next round, because we might like it at Series A, but we might like it better at Series B. And so that's the thing I love about our model, which is different from many VCs. If you care about ownership, you can't really do this. If you're a seed fund and you need 10% ownership and you need a board seat and your fund size dictates that you can only write tickets of $2 million in size, once you pass, it's gone forever, almost always.
Yep.
For us,
we just need to capture a company into the right size, right time.
We pass and we reconnect all the time. That's the number one thing we do. And then we can revisit at the Series A, we can revisit at the Series B, we can come in at the Series C. We just look at the risk reward of every round, and we're flexible. And I think that pays dividends. And so first call, we have a decision. If it graduates to the investment committee, if we like it, then we say, okay, one of the most skeptical senior team member, typically the most skeptical partner, will take a second call. And then we probe on key questions that we surface during the debate. So it might be like probe on the unit economics. How good is their payback really? How scalable are their acquisition channels? Probe on the competitive landscape. Probe on the founder's ownership. Do they have enough ownership of the company right now? And if not, how are we going to solve that? So then the partner takes a second call. They record their debrief of the call. And then we go to a second investment committee meeting. And then we have the same process. And it's either pass. If you take it to a second call, you usually like it enough that you want to reconnect.
Yeah.
So it's usually pass and reconnect or invest. And if we invest, we have set check sizes by stage. So if it's a Series A, we rate 300K. If it's Series B, we do 500K. Those modulate up and down a little bit based on where we are with our fund life and the round dynamics. But at that point, we commit. And so the entire process from start to finish is usually 2 phone calls and 2 investing committees. And we could do that in as little as 7 days. And by the way, one of our rules of venture is that we think a lot about error of omission and error of commission. error of omission, it's worse to miss that next 100x than error of commission, which is you invest in one more company that's a zero. You have a bounded downside, nearly unbounded upside. So we've designed our decision process so that it makes it more likely for us to invest in that incremental deal. So every partner has the ability to pound the table on a deal that they like. Even the analysts can do this, although they don't usually do this.
Wow.
But if there's a deal that someone sees something and they say, I don't care, I know you guys don't want to do it, I'm pounding the table.
Do you have a limitation for that? How many times you can push it through? How many bullets?
Yeah. Well, so no one's really abused it because it's not good for your career if you abuse it. Let me put it this way. You can pound the table, but we're watching you. And so if you pound the table and you're wrong, it's not not ideal. That's why the junior team members always hesitate to pound the table. I'd say I'm one of the most frequent table pounders, actually. But I probably pound the table once every year or something like that.
Well, it's not often.
No, it's not a popular decision because you're basically short-circuiting the decision process. You're saying
and then everyone is watching you, right?
So it's something. It's something you use you use it very carefully, and so.
But on the other front, sorry, Jeff. It's consensus is what is not good for venture, right? Because if everybody is in agreement, there is something wrong there, right? Because it should be like a serendipity, like a lot of risk taking, right? I mean, you should at the end of the day not really fully understand what founder is doing, right? I mean, because sometimes the best things are hidden away, right? I mean, if you know everything, you go and do it yourself. So for some reason, people are doing it, some others don't, right? So how much of disagreement do you allow? Is it like a consensus you need to achieve, or it's still like a debate and no need for consensus?
No, it's loose consensus with the ability to table pound. And so we usually get to consensus. Occasionally we have some very heated discussions. And we need there to be a champion. And if there's no champion, then the deal dies. And so table pounding is what happens when everyone does not want to do it, but one person sees something. And we agree with you. And those are usually, not usually, but often the deals that the most hotly contested deals are often the best performers. And so that's why we've implemented this decision style of table pounding.
Okay. So switching gears, when you invest, how much time, you invest a certain amount of money, right? How much time do you invest into your portfolio companies? Are you doing something what other funds are trying to do, like helping with marketing, whatever, sales, coaching? I mean, you're not the board member, but still, how much are you in the businesses? May founder call you with asking questions, advice? That's what NFX is good at. I mean, they're also investing small tickets, but they're putting a lot of effort and emphasis onto basically going alongside with founders through the journey, right? And I have so many founders who came through this NFX being on their cap table, and they said that despite the ticket is very small, engagement is very large. So it's disproportional from the ticket size perspective to how much they invest into startups or their personal brand and a lot of definitely a lot of insights, and they help much. There are many funds that claim they do, but I'm sitting on the boards, unlike you, and I know how much they may help and how much not. So I think that's important for founders at the end of the day, right?
Yeah. We love NFX, by the way. We've done a lot of deals with them. We think
they're awesome. Yeah.
What we like to say to founders is that we don't claim to have a 100-person platform team. We're not going to be doing systematic recruiting for you. We're not going to be doing outsourced finance for you. But for a very small ticket, we're typically buying 1% ownership or 2% ownership will be well north of the value add compared to our weight class. So we punch pound for pound well above our weight class. And the areas where we're most helpful are typically, surprisingly, fundraising, actually, because the incentives are not always aligned with your lead investor when you're a founder. let's say a tier one fund leads your Series A, it's not in their best interest to shop around your Series B. They want the option to preempt your Series B if things are going really well. But we serve as almost this neutral third party, like a Switzerland, where when you're ready to go raise your Series B, we know everyone. And provided you're performing, we'll make warm red carpet intros to all of the Sandhill funds and then many others that you may not know. Because we have this network-driven model, it's our job to know all of the funds that matter in our neck of the woods.
Is it only the option for your portfolio companies next round, or for example, if there is an inbound, not a warm intro, and then you really like company, do you help them to raise?
Absolutely.
So you help to find a term sheet, right, or best.
Yeah, if we find a company that we really like and there's not a lead yet, we make intros for them. And that we help catalyze the round. Now, you have to be pretty amazing to do that, because obviously if we're not on the cap table yet, it means we're really motivated and we'd like to invest. And so we do that on occasion.
There are at least 2 companies I have as an angel, which I would definitely show to you. All post revenue already, making a few $1 million in ARR and without any investments from outside, bootstrapped.
Love it. We will talk about this afterwards for sure.
Absolutely.
And so our network is our superpower, and our ability to help you fundraise is our superpower. And then beyond that, we do have a full-time operating partner on our team who was a former marketplace founder. His name's Jeff Berger. He is a serial entrepreneur. He built and sold his last business for $100 million to private equity. It was a jobs marketplace. And so he serves as our unified point of contact with FJ Labs. And it's very different. A lot of other funds, for their head of platform or head of portfolio or whatever role that is, it's often someone who's a bit younger and more community-driven, network-driven. But here, this guy is a former founder. So if we have, for example, Ryan Peterson at Flexport, he's not going to give the same time and attention to a young MBA as he is to a fellow founder. And so JB, he's our secret weapon in the sense that he can talk to anyone in the portfolio as a peer, as a fellow successfully exited founder who's gone through the same trials and tribulations and can give helpful advice. And so when you combine these two things, we say up front, listen, we are not on your board. We are not going to be bothering you. We're going to be hands off. We're going to be as helpful as you want us to be. Many founders don't want you to be all that helpful. And if you ask most founders, they say that VCs are typically net negative. They're not only not value add, they're value detracting. And so we're going to be relatively passive, but use us for our network. We have an amazing network across VCs, founders, our LPs. We can open a lot of doors for you. We can help with intros. And by the way, if you're a B2B startup, particularly if you're targeting other startups, we have one of the world's largest startup portfolios. We can make intros over thousands. We have over 800 active companies.
like a YC kind of stuff. Yeah.
Like in that sense, yes.
Yeah. Well, maybe a few questions on how you structured within the term you mentioned. You have a bunch of analysts. You yourself were promoted to a partner. So is there any clear career path for your junior colleagues to become partners? Do they know what they need to do to end up being a partner in the FJ Labs at some point?
Our analyst program is similar to some of the other funds that you see. It's basically designed to be a 2-year program. And at that point, typically, there is no expectation that you will stay full-time after that. Now, I will also say that this is a relatively new program, and we've already hired full-time one of our great analysts. So we probably set a dangerous precedent here that now all of our analysts are going to try to become full-time. But the reason for this program is that just being realistic about the dynamics of most venture funds, there is not infinite room for upward mobility. We have 5 partners now, and I think it'll be hard for us realistically to add to the partnership anytime soon without dramatically expanding the firm. I mean, this is why you see the existence of these kind of 2-year analyst programs, because you can't always promote people up. Venture is not a scale business in and of itself. It's much more of an artisan boutique business. And you look at, there too, now that I will say also, you're seeing that change a little bit with some of these like hyperscaler funds, like Andreessen GC. They are becoming dozens of partners, hundreds of employees.
Well, I was once there was an attempt to interview me myself into one of these funds. I don't want to name it. I got kind of a request if I want to join. So I was surprised to be seen as partner number 172. Yeah. And I'm not kidding. I asked, was it like a partner role? They said, yeah, it's just partner. How come they have so many partners? They said, well, it's like $40 billion fund. I mean, what do you want?
So what we say is, listen, we say everyone at the firm, associate and up, is on partner track. And so at some point, right now we have 5 partners, 2 associates, 2 analysts, and our operating partner. At some point, if you're an associate and up, the expectation is that you're on partner track. And if you're not partner track, we're going to let you know, and we might help you find a better home. But the reality is that we're probably right-sized as a firm at the moment. And so we're super happy with everyone at the firm right now. Everyone's doing an amazing job. The analysts they're wrapping up year 1 of the program. At year 2, we'll figure out if it makes sense for them to become permanent, if they go to a portfolio company, if we help them land in another firm, to be determined.
Absolutely. Yeah. So my last part of questions for today is all about evolution of marketplaces and consumer-facing businesses. I think that after this Uberization of economy, and you were part of Uber, I think there was not much left, and there is every field being tackled with a lot of opportunities for building up marketplaces of all sorts. There is no one single solution being left outside of customer-facing apps, right? There are millions of apps for everything. So how do you see this evolution going forward? Where you put your bets? How you think marketplaces will evolve? Obviously, everything you spoke about, like this network effects and other powers, that will stay, right? But obviously, marketplaces will change. Consumer-facing apps will change, and those who are on top probably will be replaced with someone who is evolving now. So what you see in 10 years from now, say, and what most of companies are investing in are those which will, at least the winners will end up being winners in 10 years. So what do you think will happen to marketplaces overall and consumer-facing apps overall, especially with this new wave of AIs? Maybe there is something, maybe blockchain, I don't know, like Web 3.0. So whatever you put your bets on. So it would be interesting to see your trending forecast for that type of things.
Yeah. It's an amazing time. We're watching with great interest. We're allocating carefully. We're going back to what you said before. We're not playing much of the infrastructure game. We're not in any of the foundation models companies. We're not really in any of the picks and shovels per se. We're not in any data center companies. And we're thinking long and hard about the future of marketplaces because there's so much changing. And there's some really interesting new paradigms popping up. To me, I'm very excited by voice, for example. I think you're going to see a whole wave of voice AI startups. But going back to what you said before, and going back to what I said about the 7 powers in Hamilton Helmer, network effects, in my opinion, remain one of the key sources of defensibility. And the reason that even though anyone can vibe code an Uber competitor nowadays, the reason why Uber reigns supreme is because of that liquidity. Because anywhere in the world, you can call a car and it'll be there in under 3 minutes. Mm-hmm. And that makes it extremely hard to disrupt. And so I think about some of our star marketplace companies. I think about Vinted in Europe, which is the dominant secondhand platform. it's going to be very hard for an AI native competitor to go and disrupt Vinted. Vinted has and controls the liquidity. Rather, what I think is going to happen is that Vinted, with the amazing tech team they're having, is going to benefit from AI. And we're seeing a lot of marketplaces actually implement these AI tools to make them more efficient, to increase their fill rate, to increase liquidity, to reduce the friction to list. And so in many ways,
innovation is becoming also easier than ever before, right? I mean, for these big companies, right?
Totally.
I mean,
and by
those
the way,
who were not innovative for decades now can be innovative back to like their early days.
In many ways, AI is a game of kings. And I think that this is one of the interesting waves of technology where the incumbents are benefiting. And by the way, look at the public markets. Look at how eBay is trading.
Yeah.
You see that actually the large scaled players that have scale economies and network economies are doing very well. That's not necessarily what you would expect. And so in the case, for example, we're investors in a startup called TopSort. TopSort is using machine learning to help offer better auction-based ads for marketplaces. So this is like Amazon ads, sponsored listings. They work with a bunch of marketplaces in Latin America to give them top quality ads and promoted listings. And so you see this. We have a company called PhotoRoom. They started as consumer, but they're really more B2B nowadays. PhotoRoom allows for mass uploads and customizations of backgrounds and cleanups of imagery. So if you're eBay, you want every listing to look perfect or improved, you work with PhotoRoom. And so these are all AI startups that are actually additive to the incumbent marketplaces. And if you're Vinted and you control the liquidity, you can have another way of accessing your marketplace by voice. So voice AI startups can be good for Vinted. Now, that don't get me wrong, there are risks. And you see, for example, OpenAI and all of the amazing new product launches that they have. It doesn't keep me up at night per se, but I could see a world where OpenAI basically captures the demand side and then goes and hunts the supply. And so you have. Do you
think that companies like Google are endangered with OpenAI? Do you think that they may lose substantial market share?
I used to think Google was in danger, and now I've changed my mind. I think Google is in an amazing position, actually, because they have so much free cash flow. The CapEx needs of these companies at the moment are enormous, unprecedented.
Yeah.
And Google has the world's most beautiful business, and their team is amazing, and Gemini is exceptional. Now, it is the ultimate innovator's dilemma, where the better Gemini gets, the more they attack their own business model. But I think they've done a good job of building it carefully while maintaining cash flows. And so I would not bet against Google, actually.
Where do you see, what kind of marketplaces would you like the most? Which areas, which industries? I mean, there are many like healthcare, like construction, agriculture, where things are yet not being yet put into this marketplace mode, right? What else you think? And maybe you can also elaborate a little bit of geographies, where you see like the biggest growth for this kind of stuff. What do you think of fintech, for example? Do you have any bets on payments?
Yes, and yes, and yes. And so for us, we think there's a huge opportunity in B2B marketplaces right now. B2B is about a decade behind consumer and digital adoption. And there's a really interesting why now, because a lot of these family-owned businesses have the next generation taking over, and they're digital natives who are used to buying and selling anything on their phone. So why can't they do business on their phone as well? You should be able to buy and sell construction equipment or ag products or whatever on your phone. And so that's starting to change. And you're seeing these behaviors starting to change. Now, there have been a number of false starts in B2B marketplaces, but we're starting to see some breakout. And we've gotten burned by a couple, don't get me wrong. But you're seeing some scaled ones that are quite interesting. I mean, we're unfortunately, going back to anti-portfolio, we missed Equipment Share, which is a very interesting construction equipment marketplace in the US. But I'm very excited about one in Brazil called Cayena, which is like a restaurant supplies marketplace. They've scaled with amazing economics. They're starting to do really well. We're investors in dozens of B2B marketplaces all around the world in different verticals. And so I'd actually say we're more excited about B2B marketplaces than we are about consumer marketplaces right now. That said,
and it's like more global than just the US market, right? So you just do a lot into like Latin America. Do you do anything in Africa?
We've done a little bit in Africa, carefully. But you're absolutely right in that markets where the consumer might not be that interesting, you can still build very large B2B marketplaces. But we are careful with some of the emerging and frontier markets. We've actually done quite well in some of these, but nonetheless, you want to make sure you're being careful. You're working with trusted local partners on the ground who you know and you trust, and just there's a little bit of like a buyer beware in some of these markets.
Finally, Jeff, any advice you may give to founders, especially early stage founders, anything they should care about the most, something or what is changing, ever changing in this world, what they should really look after? What's like the most important thing they should focus on?
Fundraising is a tool to get to a place. I think a lot of founders over-index on fundraising as their most important KPI. Like, oh, I raised a $50 million round. First of all, the more you raise and the higher the valuation, the higher the bar that you've set to execute.
And more responsibilities you take. Yeah. Also in terms of your cap table stack.
And by the way, the more risk you've embedded into your startup, and now your investors expect a certain multiple on that, which means that you have to act with more risk. And it's a lot of people, especially nowadays, you see all these fundraising announcements. People are making videos to announce fundraisers, which implies that fundraising is the name of the game, of the goal. No. Fundraising is used to get you somewhere. And so I would recommend to founders, especially in this era, going back to what we said before, where you can do more with less. And the limiting factor is not often capital, but agency, particularly in a lot of these more asset light digital business models. It's a very different story if you're like a AI company and you need to raise $1 billion to spend on GPUs.
You need like 50,000 GPUs. Yeah,
right.
It's a different
game. And you do you, like, that's fine. I'm referring to marketplaces, to network effects businesses, where actually you can keep doing more with less. Think about, maybe you don't need to raise that mega round. Think about, what if you raised less and you diluted less, and then you didn't create such a binary outcome where you have to be a $10 billion company or a zero. $100 million exits are very good if you don't raise that much capital. Now, I'm talking against my own interests here because as a VC, I want there to be fundraising so I can invest. But more founders should consider good, more bootstrapped outcomes. They talk about seed strapping as this new phenomenon. You raise one round and you never dilute again, and you sell for a great outcome and you compound. We have a company like that. We invested in 2014, 2015. They raised basically nothing for years and years. And now they've raised one growth round and they're at 100 million of ARR. And they're in control of their own destiny. And it's basically guaranteed that they're going to clear 100 million themselves. Investors are going to have an amazing time too. So once you get on that venture treadmill, that like hamster wheel, it's very hard to get off. So just buyer beware and consider not creating such a binary outcome with your company.
It's an amazing and very controversial advice. So that was Jeff Weinstein, who is a partner at FJ Labs, and Victor Adlovsky. This podcast was brought to you by R136 Ventures. Please listen and subscribe to us. This was a podcast, Ventures from the Valley, and thank you all for listening and watching us. Jeff, it was my pleasure and honor to have you at this podcast. Thank you so much.
Thank you for having me.